Hi, in this video I'm going to look at a concept called return on equity. And that's a useful concept because it helps investors see if they're getting a good return on the money they've put into a company. So to explain this concept more clearly, let's dive straight into an example. And let's imagine I own a hotel. And last year, this hotel, it had revenue of £400,000 and the post-tax profit was £80,000. So when you just look at those numbers quickly, they look pretty attractive. 400,000 revenue, 80 grand profit. That's a 20% profit margin. Looks pretty good, doesn't it? But there's another number we really should be looking at, and that's the amount of money I initially invested in this hotel to get it up and running. And that's where the problem is. I invested £4 million. I invested 4 million, but I'm only getting a profit of £80,000. That's a 2% return on my investment. I could have got a 2% return if I'd just gone and put 4 million into a savings account and not taken any risk at all. So far, actually now, things don't look that good. So the proper definition of return on equity is profits or earnings over what's called shareholders' equity. If you're wondering what shareholders' equity is, it's basically that £4 million number. And it's always actually the same as net assets. Net assets is total assets minus total liabilities, and it's also £4 million. Net assets are always the same as shareholders' equity. Now, as I already said, we've gone through this calculation. We've divided 80k by £4 million. The return is very low, 2%. Let's move on a year and see what happens. I decide I'm not going to pay any of that profit in a dividend to me. I'm going to keep all of that £80,000 in the business and reinvest it. So what then happens is that £80,000, the retained earnings, are added to the £4 million initial investment. So we now have shareholders' equity of £4.08 million here. And if we imagine that profits stay the same next year, it's still an 80k profit. We then divide 80,000 by 4.08 million, and we get a 1.96% return on equity. So things have gotten even worse. I've reinvested the profits, which means a higher shareholders' equity, but because profits here haven't risen, my actual return on equity has fallen even further to 1.96%. So the only way I can boost that return on equity is to try and push up the profit in future years. And if I can't do that, this is really looking like a pretty poor business, and I probably should think about doing something else. So we've established 2%, 1.96%, way too low. What is a reasonable return on equity? Well, I think, typically you'll see a lot of listed companies with returns on equity in the region of sort of 10 to 13%. I'd say you should be aiming for at least 15%. If you got 15%, that's a nice hurdle to have jumped, and I'm a bit more interested in the company as a potential investment. It's also worth looking at other companies in the sector. So if you're looking at investing in a restaurant chain, compare it with other listed restaurant chains, and your return on equity, the company you're interested in, should have a return on equity that is at least equal to the average return on equity for the restaurant sector. What's also very useful, return on equity is useful because normally you'd say if there's a high return on equity, that suggests you're going to get a high growth rate for the company in future. Having said all that, return on equity is not perfect. There are problems. The problems really arise if companies have a lot of debt. If a company doesn't just fund itself by issuing shares and retaining profit, it also funds itself by borrowing from the banks. So I'm going to come back to that issue of debt and returns on capital in a future video, examine that in more detail. But before we do that, it's well worth looking at return on equity. And until the next video, good luck with your investing.